George has over 11 years of work experience in equity research. He is the fund manager of Quantum Mutual Fund. He covers multiple sectors and he's a postgraduate diploma in management finance from IMT. Over to you, George. Looking forward to hear from you.
Thanks, Roshni, for the introduction. So I would primarily cover on what were the major announcements from the budget from my sectoral perspective. So overall, if I were to give a top-down view, so there is a distinct shift from the capex push which we used to see in the last few budgets, and so until now it was a long-winded process where you are promoting supply and eventually that leads to some demand generation in the economy. But in this budget, government has decisively given a push on the consumption front. And the other major focus was to generate more employment by giving some sort of incentives to the SME sector, where SMEs are known to create a lot more labor-intensive jobs, or even on a manufacturing front, their share is quite sizable. But having said that, the economic activity over the last couple of years post-COVID has been quite strong, and that has resulted in fairly high base from an earnings perspective, and therefore, from an investor point of view, from an equity market perspective, the stock selection and asset allocation is quite important. So coming to the key sectoral. Just give me a second. Yeah, sorry. I did not realize the video was off. So coming from a key sectoral announcements, so when we look at the spending for the rural economy, it was kind of flat except for certain schemes like the KCC, which was the Kisan Credit Card, where they kind of increased the allocation slightly on from a budget perspective, while it could help farmers to get slightly better access to credit. But generally what we have seen is the agri loans are slightly more, from a delinquency perspective, they remain slightly higher, and therefore the exposure or the agri loan book generally does not change much as a percentage of the overall credit. It has not it does not generally materially change much, even despite the policy. So from a personal taxation perspective, there is a very clear benefit in terms of the tax slab. But if we were to assess the tax slab from a inflation adjusted perspective, so in FY21 was when the new tax regime was introduced, and if we were to assume a 5% annual inflation, so that, let's assume if you were to fall in a 7.5 lakh kind of income bracket, and if you adjust for the tax inflation, that translates to about a 9.6 lakhs from a 5-year forward perspective, from an FY26 perspective, primarily because your spending power kind of keeps reducing year on year, because inflation eats into some bit of it, and you are foregoing some of those deductions which used to get in the traditional tax regime. So when you factor both of these, the difference is not a very stark difference like what we see at face value. And therefore, even though this tax structure is estimated to cover a sizable population, where out of the 8 crore taxpayers, this is estimated to help almost more than 5.5 crore taxpayers, the extent of benefit may not be that material like we are kind of foreseeing. So the other key announcements which happened from a sectoral perspective was in terms of promoting the housing scheme, where the affordable housing scheme under Pradhan Mantri Awas Yojana had seen some bit of deceleration in spending in the current year. and that is kind of addressed, and they have kind of increased the allocation there. Some of the regional cement players could be major beneficiaries of this, especially in eastern side of the country, where a lot of constructions or house building happens under such schemes. This could be a major push. So even some of the housing finance companies which has exposure to affordable housing schemes, they would benefit from this scheme. The other major announcement, like I said initially, was in terms of increasing the coverage for the MSME sector, where the budget has announced that such MSME schemes can be the ambit is expanded from the current limit of, from a turnover perspective or a revenue perspective, of about 5 crore per annum to enterprises which have revenue up to 10 crore. So that is a major push in terms of better credit availability for the MSME sector, because the MSME sector falls under the priority sector lending, where banks need to maintain certain level of exposure. And as this limit is expanded, more enterprises would be eligible to avail such loans. And even this is some sort of credit guarantee cover, where government kind of backs up for some of the initial credit losses or NPAs which are likely to come. And therefore, the lending companies would be eager to lend under such scheme. One, it makes up for the priority sector lending, where banks have to allocate certain defined limits. For the larger banks, it's somewhere around 40%, and that goes up for certain specialized small finance banks and stuff. So plus there is lower risk of delinquency because of the announced scheme, and therefore that is quite positive from a MSME perspective and from an employment generation perspective, because MSMEs are known for better share in terms of manufacturing industries which are more labor intensive. So coming to a capex perspective, so unlike the popular notion, the spending, it looks reasonably fine. From a revised estimate perspective, the growth is around 10%. And so from an FY24 actual spending perspective, even the revised estimated is slightly higher at around 7% compared to 24 levels. So which is a reasonable pace, considering that the capex has been running at a fairly elevated levels for the last few years. But having said that, the flip side here is, so from a revenue assumption perspective, government has taken certain elevated assumptions in terms of income tax growth perspective. So one, on the personal tax side, despite giving such foregoing an estimated 1 trillion personal income tax and a high base of some of the capital gains tax, which is assumed in that revenue assumption. So considering that if that does not materialize, there is a possibility that some of these capex spends could be curtailed back, and that needs to be watched out. But otherwise, from a headline number, these numbers looks reasonable. So the other major side where we have been seeing some bit of action is in terms of promoting the domestic manufacturing. So some of the segments like electric vehicles and batteries, some of those components, the duty has been slashed, and even some of the completely built units, the import of completely built units, tax have been slightly increased. So this should promote manufacturing on a longer term basis. But having said that, so our competitiveness compared to other geographies still remains fairly low. So this could be a gradual improvement rather than a very rapid shift compared to the current levels. So while the budget has certain favorable announcements, but there is only so much that a budget can do. So from a earnings perspective, if we look at it, the earnings base is currently on a higher base because there has been some benefit from input cost moderation and things which has happened in the last few years, which may not continue going forward. And therefore, so we are on a fairly elevated earnings base, and with that perspective, so the amount of growth which is required to maintain the current valuations is the ask is quite high. And therefore, you need to be quite cognizant about the valuations and funds which have a bias in terms of selecting stocks from a valuation sensitive perspective, that those funds could outperform in this current market. So even if you look at the overall market setup, there is a lot of volatility, and even for slight earnings disappointments, you're seeing stocks reacting quite sharply. And if you were to look at the median stock fall from their recent highs, so unlike the broader indices, the fall has been quite material. So in the last few months. So even despite this, the valuations continues to be slightly on an elevated pace. Of course, the situation has improved over the last few months, but still, from a considering the high base and the stellar rally which we saw in the last few years, the valuation continues to be elevated, and therefore you should be sensitive uh, to funds which have a bias towards valuation. And needless to say, there is no consistent asset class which wins every year. Therefore, it is important to build an asset allocation, to stick to an asset allocation. So if you look at historic periods, so you would realize that there are years when equity has done well, and there are years when markets have gone through turmoil, and those were the times when gold kind of supported. So it's important to have a very balanced portfolio. You need to have an emergency corpus where which can be parked in liquid fund, and then you can have a mix between equity and gold, which are quite complementary in nature, considering the past several cycles. So I'll take a pause here and I'll pass it over to the next speaker.
Thank you, George. Thank you so much for covering the sectoral impact in context of the budget, and also giving us an insight about the market outlook. George, I have one question for you. You talked about the capital goods sector, and you mentioned the slowdown in capex which has happened this year. Merely growing by 7%. Do you see a repeat of what happened to the capital goods space? The valuations peaked in 2008, and post GLC they crashed, and it took them nearly a decade to recover. The same thing is valuations are now have run up too much now, and they warrant an exponential growth in earnings from year on. With the slowdown in capex, what is your view on this space? And even for the next year's target is just a mere 10%. So how do you view this space?
Yeah, thanks, Roshni. So when we look at the overall capital goods universe, so when we see at their order book or execution, our sense is most of them should grow at around 14 to 15%, and that's something which we are factoring. Of course, next year could be slightly higher, but the valuations are nowhere near justifiable levels. So our sense is, so even if the capex space looks okay, but we do not expect that to materially outpace what we have seen historically or materially outpace the nominal GDP growth rate for a very long period of time. So from that perspective, our sense is there is a lot of fraud in that segment. So we had few holdings there, which we have exited. So right now the exposure to capital goods is zero from a portfolio perspective.
Okay. Thank you, George.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.